Our next guest is Tim Clark, the president and CEO of Fury Gold Mines. Now, Fury is an earlier stage gold development story in a great jurisdiction, Canada. They're in both Nunavut and Quebec with advanced stage exploration moving towards development. I've had Fury on the show a handful of times, but I haven't had their new CEO, Tim Clark, on. So this is the first time that Tim's come on the show. I'm excited to pick his brain today. I hope you enjoy this.
This is Jay Martin.
All right, guys, welcome back to the Jay Martin Show, and I'm joined right now by Tim Clark, the CEO of Fury Gold. Tim, it's great to have you on the show. Thanks for making time.
Oh, Jay, it's great. No, I'm looking forward to it.
So I want to start this conversation with some macro gold commentary, Tim, because with your background, 23 plus years, on the money side of the business, you've recently made that pivot over to company leadership. I want to talk about why you made that transition, and most importantly, why now. But give me your thoughts on the gold landscape, because if we lean on like the historical metrics that we've believed contribute to a strong gold market, they're all present right now at the macro level. Yet the gold market's kind of sleepy. So what do you see when you see that? How do you justify and explain that to yourself right now?
Well, I mean, I think everybody sort of has a question mark about this right now, and it's not an easy one. There's a lot of complicated ways you can explain it. Look, having sat on a sales desk, on a trading desk, for that long at those companies, I worked for a number of large bulge bracket global companies, as well as some Canadian ones. And there is a psychological effect in investing that people forget about. They like to chart a lot. And if you look back to like guys like Peter Lynch of Fidelity, they did a lot of their backroom work analysis, but at the end of the day, they would walk into a store, he'd walk into a store or a business, and he says, this makes sense to me from a practical point of view. And as I sit here and look at where I came from, I left the industry a couple of years ago. I knew I wanted to get into the corporate side. I started out on the board of Fury about a year and a half ago. Then I became CEO this time last summer. And really my decision came down to, we've had a big pullback for 10 years in terms of the gold performance. I think you can point to difficulty with the industry in terms of managing its capital allocation, but it's also, you get these heightened times of where gold is important. Gold really is a great diversification asset. I mean, it's a currency in one way, but it's an asset in another. And there are times where when it goes incredibly well. And I felt that at this time last year that I saw what could potentially be a lot of inflation coming, which has happened. We pumped in over $5 trillion into the marketplace just in the United States. And money supply really, it dictates the price of our commodities over time. Gold, to be honest, has actually held up pretty well. We've floated between 1,700, 2,000. It's not what we were hoping for to go to 2,500. But you got to look at like these producers like Newmont and Barrick and others. They're reaping huge cash flows. Newmont's got a 5.2% yield right now. They're a $33 billion company that's pulling in $2.5 to $3 billion a year in free cash flow. What's not to like about that? So when people are negative, I don't really completely agree with that. I do think that we're in a place where the Fed is going to have to position themselves and play tough. Yes, we're going to have to increase rates. We're going to fight inflation. I think part of it is the psychological effect that most people haven't grown up with inflation like we have now, and they have to play tough. But they can't play tough to the point that they bury our economy with pumping up interest rates for that long. So I do, as I mentioned offline, there's always been that psychological effect of overselling and overbuying. I feel like we may not be in the bottom in terms of where we're supposed to be with gold price and the equities, but I think we're really close. And when you look back over the past, say, decade, 2020, 2015, we had big pullbacks and we had 150% rallies within 6 months. I think that with the size and scope of our sector, you don't necessarily need gold to go to $2,500 to have a lot of success in these equities. It's a fragmented industry. It's a relatively small industry to others. Liquidity is an issue. And I will tell you right now, I've spent the past year talking to a lot of these institutional guys. They're looking to buy into the gold market. They just don't know when it's going to happen. But when it does, that money is going to be incrementally helping to push this sector up a ton. And that's what you're looking for, is those years of substantial outperformance. And I think we're pretty close. I think this could happen. And the difference now than say 2015 is these companies are really well positioned. You have companies that are billion-dollar companies with $700 million in cash, $650 million companies with $300 million in cash.
Yeah.
They're not going out of business.
No, you know, I watch, okay, so I would maybe echo that I don't know that we're at the bottom yet. I think we're pretty close. I mean, what I watch, because we all, you know, we play the hand that we've got, right? My hand is conversations with mainly probably a lot of the same individuals that you're pitching right now. When you talk about the institutional investors that you're telling a story to over the last year and a half, those are the kind of individuals I have on my show. And I'm always looking for consensus in one idea. Like, and I would say that what I'm hearing today in terms of the sector agnostic generalist money managers, when they talk about gold, is much more bullish to me than it was 4 months ago. It's not quite at the point where everyone's like, yeah, we need to start allocating cash this way, but we're far further down that road than we were 4 months ago. And that appears in a variety of ways. But mainly it's just that most of the money managers I have on these days are suddenly, they've just got some version of a non-zero gold position, right? Whereas maybe 5 years ago, they didn't own any, right? And now they own a bit. And anyway, so what do you watch, Tim, when you say you're not sure we're at the bottom yet, but we're probably close? You know, what are you going to see that's going to trigger you there?
You know, it's so interesting. You know, I do a lot of personal touches with a lot of the people that I used to work with, both on the corporate side and in the buy side. I know a lot of people look at you know, valuations. They look at money flows from the ETFs, GDX, GDXJ. I always felt like when I was sitting on the desk, I could tell when people were getting interested, because they would call me up and they would ask to get, you know, research reports. They'd ask for data. They would start doing the work a couple of months ahead of time.
Yeah. Okay.
And I'm not in that seat anymore, but judging on the comments that I've heard in the last 6 months, categorically they're doing more work. And the other thing that's really interesting is they're not just doing the work on the large caps. They're starting to do the work on the small caps. And the reason being is, if you're, as an example, a gold sector portfolio manager, how do you outperform? Well, you've got to buy the big ones, because those are the big liquid names you have. But you really, where you juice yourself in a bull market, is you buy the small mid caps. And when they start talking to me about small mid cap names, that means they're bullish, and they're looking for, one is a trustworthy person to go into, good management team, discipline, financial stability, a good resource, right?
Yeah.
And a lot of these guys don't have the day-to-day connectivity about it. So having been in, well, for my background, I spent a lot of time in the Boston area. Boston was probably the #2 city in the United States for natural resources. And we had some of the largest hedge funds in the world based out of Boston. And New York, obviously #1, but I got a lot of visibility and a lot of guys, and there's a ton of money that's sitting there. And what they're telling me is like, and this is true with all investors, they would rather buy a stock up 20% than at the market right now. They'd rather give up 20%, because they have to defend themselves when they go back to their institutional investors on their end. Why did you buy this stock and sit there for a year? Well, that's a hard argument. But if they have no problem buying up 20% when they think it's going to be a 3 or 4 bagger, right?
Yes. Well, that makes sense to me. You know, it's funny to hear you say that about Boston, and I'm not necessarily surprised, but I was there like maybe 5-6 years ago. So, you know, really like the trough, some of the ugliest years in the gold market, right? And I was asked by a handful of junior gold companies to assemble a room full of investors, and then we, you know, do the matchmaking thing. And we went down there, and what we found is that there's so much money in Boston, but the funds are so large that they weren't even able to invest in the kind of companies we were bringing down. They're like, you know, sounds good, and on a personal level, maybe, but we could never invest in you. You're way too small.
It's tough. Absolutely. I mean, when I was on that side, I really didn't pay attention to the juniors as much
Yeah,
because there's a liquidity issue. Ironically, um, I've gotten a lot more people involved in our company that you probably wouldn't have thought of. And I think
perfect.
one of the things that, again, going back, they will put money in with people they trust. The problem is if you're sitting in Boston and all the actions in Vancouver, how do you understand what they're doing because you don't know them,
Yeah,
right? It's a
yeah,
harder thing to do. It's just like, look, Europe loves to invest in Africa. They don't like to invest in Latin America. And the reverse is true with the United States. It's what
yeah.
you know, who you know, your relationships are really important in this industry more than people think. It's how
Mm,
you get business deals done. And I was down at the BMO conference in Miami last spring, and I sat down with one of the marquee guys that you would know, but he's since retired, but he's working with some other companies. And his comment was, "We're ready to do M&A. We're here for M&A. We're not here for investors." And I said, "Why is that?" And he said, "Because M&A is done by relationships, and we've all been, locked up for 2 years with COVID. We've seen some of that, and this is the next leg sort of to stand on with investing in this industry is there's a huge amount of pent up M&A. And so if gold stays flat and we see a bunch of consolidation, and you got to remember too that we have been, as an industry, terrible about investing in our future with exploration. 16 out of 20 companies in the last decade are in arrears on their reserves. They need to replace them. They need more money in exploration and development. So
yeah.
that's interesting to me too. But that's outside. That's a micro thing. I mean, I think the micro story is really there right now. It's the macro story that we all got to get our heads around to give confidence back in the market.
I love the underinvestment narrative as a retail investor because what that creates is a bit of torque and pent up demand, right? And a bit of a coiled market, right? When things turn, they have the potential to turn very, very aggressively because there's going to be a bit of competition for good assets. So actually, that's a good segue. Let's talk about Fury, right? And why don't we start, Tim, with what inspired you to
Yeah.
change teams, right? Like you went
Um,
from
look, I fell in love with mining a long time ago. I just liked it. I covered tech, I covered healthcare. I did a ton in healthcare for a while. There was a lot of money to be made there. I went and sat in the desk with Merrill Lynch. It was, 20 guys deep. I was there 8 years and I was still the junior guy. No one wanted to cover natural resources, and I covered Canada. And I was like happy with it because by the end of it, I really dominated that sector, and I moved on to a couple other companies, one of which was Barclays, and they were probably arguably the number one or two global commodities platform. And Merrill, had the major conferences down in Florida and over in Europe, and I really got to know the CEOs of the companies over 20 years. And when I brought them in and I basically raised the money for with US accounts for a long time, and it's global. And I got to travel to Africa, Latin America, all over Europe, all out in Canada. I really enjoyed. I love going to site. I love working with the people. And so when I left the industry, which was the brokerage industry, which was starting to break down, it's a young man's game per se. A lot of my close contacts were retiring from the buy side, and it was a natural time where you learn, then you do, then you sort of teach. And I watched a lot of CEOs come through Boston where I felt like I didn't want to be on the side of the table. I want to be across the table where I had a lot of the answers because it's not a complicated business, but you got to do things the right way. And I think there was room for a guy like me where I really wanted to build a business, not just a trade. We talked about the importance of where we came from as we were both athletes growing up. Team is a huge thing. Being passionate about what you do, building success over time, doing a lot of the little things right. And as I started to speak with investors when I first came in, it sounded to them kind of odd. Like, who is this guy? Why is this a pitch? The reality is like I've gotten my family in this company. I've gotten my sort of top investor relationships, both in the corporate and the institutional side. the one thing they tell you is if you lie to them or you over embellish one way or another, they can't trust you. They are happy taking risk. They just don't want to take management risk. And there's also the side where I think people get really emotional about spending, whether it's drilling, whether it's developing, and it becomes an emotional ego thing. For me, it's not. I'm very financially driven. I'm very practical. And what I think is the best way to build a investor base is through relationships. And you get that by getting to know people. They trust what you say. And if you come back and you've had a mistake or something went wrong, you sit down and you explain to them, here's what I was thinking, here's why I did it, and everybody's good. And I watch some of the top institutional, or not institutional, but corporate CEOs do that and have a lot of success. And at the end of the day, when you put yourself in the shoes of an institutional investor or mid-tier, or even a retail investor, they've got so much going on in their lives. The last thing they want to do is worry about what you're doing with their money. And if they feel that you're competent and you're trustworthy and you're doing things for the right reasons and spending their money by putting in the right things, they're fine with it and they're happy with the risk. But when you start through, it's like going to the roulette table. If you go to a casino that you don't trust, it's all of a sudden a problem, right?
Yeah. Yeah. Okay. So
that's why I got into it, and I've really felt I've fallen in love with what I do, and I'm not going anywhere else.
love that. Okay. So I want to dive into the company details a little bit. I imagine one thing that the institutional crowd likes about you is that there's a lot of companies right now with depressed share. I mean, all companies in the junior space have pretty depressed share prices. A large handful of them have to go out and raise cash at that share price, which
Right.
can rub investors the wrong way. Fury's got, I believe, 10 mil in the bank right now.
Yeah. Yeah.
So I imagine you feel pretty secure about your ability
Yeah.
to weather the storm.
We wish it was more, no doubt, with the market the way it is. But look, I came in here. We were under the gun. We really needed to raise some money. We went back to our founding investors. They helped us raise $5.5 million. The one thing that why I really kind of took the job is that we had 4 projects going in Canada. And for a junior company, I thought it was too many, and there was an opportunity to monetize our Homestake Ridge.
Yeah,
which we did.
Yeah,
and so we've got it's worth 55 million, give or take, right now in the market. We own a third of the company, is 76.5 million shares. Where we had a 1-year trade hold on that to trade, so it's coming up in February. But we still need to raise some money. So we were going to do a deal last spring, and I decided before we went to a broker, and I went to a corporate relationship and institutional relationship that I had done a lot of work with over the last 20 years, and they both backed me, and they were happy to do it. They believe in exploration. It's public now that Fidelity took a 7.5% interest in the company. That was the bulk of the money, but we had another, I can't say it publicly, but it probably is already out there, but we have one of the top 3 producers globally in gold that stepped in out of Toronto that backed us as well. And both were really important. They created an alignment for the company, a potential exit strategy for the company. And it's important to be aligned with big, successful companies that help you make good decisions, and we can go to them and ask questions, and I do all the time. It's a lot better than doing it by yourself. I think it's very hard to be successful by yourself. Newmont also owns 6% of us as well, and they inherited that, but we do also, in addition, have just completed an update on our joint venture with them, and we've bought out Azimut together, and now we're basically 50-50 with Newmont. And that's demonstrated a lot of confidence. So from that point of view, I think it's an unusual story because there's not too many juniors under 100 million market cap who have not one, but 2 of the top 3 producers, plus probably arguably the #1 institutional firm in the country, if not the world. And the Dolly Varden that bought Homestake, we've taken 2 board seats on there.
Good.
The idea is to monetize that at some point, whether you do some block deals next year or something like that. But the idea that, frankly, the target is really to sell the company off to another. And the most likely acquirer is Hecla. They own 90% of the land around it. Phil Baker is a personal friend of mine. I've known him for 20 years. And they would love to buy it. We have to help them get there. And this is where these relationships come in hand, where, you know, I've been on the phone with Phil and I said, well, give us a guideline. How do you want to see us get there? How do we help you? Okay, let's sit down and tell you. And I think that what investors don't realize is they focus too much on the trading volume, some of the specifics, but you got to look at the psychological thing. Again, as I talked about earlier, relationships can really drive success in this industry. And people want to see us win. They want to see you successful. And boy, it's a lot nicer to work with that scenario, right?
Yeah. I like the positioning. I like the strategy and the optionality for more cash down the road.
Yeah.
You know, what every retail investor is going to want to know from you, Tim, is, you know, okay, that sounds good, right? Gives me some confidence in the future. But
Right.
near term, you know, I like how you simplified the company, got rid of Homestake. You got good projects now in Quebec and Nunavut. Let's talk about those. Talk to my retail audience at this point, Tim. What's going to make the share price go up?
No,
Get excited
listen,
about?
valuation is all great, but everybody really wants growth, right? And they want a big expiration target. And look, these big guys would not have come in here unless we had a potential to get a really big target in discovery. So we own Eclair out of James Bay, and that's a 1.3 million ounce resource. We've had some great success recently out at the Hinge, which is on the western side, but we've also targeted an area called Percival, which was relatively unexplored. Historically, there was 100,000 ounces there. It's 14 kilometers to the east. What we're seeing looks really great, and I think that those results are frustrating because we're all waiting for assay results. Everybody wants the latest, greatest news. Again, my position is be patient. You know, it's coming, and we're as excited as anybody. And if we have some big hits there, it could be really transformational, because James Bay is in a phenomenal area from an economic standpoint. There's not power, there's hydropower everywhere, massive amounts of electricity and road systems. It's a lot cheaper than going to many of these places in the world. There's the political issue is irrelevant in Canada relative to going down to Africa or Latin America.
Yeah.
I will tell you, when I was on the sell side, every meeting I walked into, the first question from investors was, where are you located?
Yeah.
Okay.
Yeah.
And it better be in a good jurisdiction or they're not coming.
And more so today than ever, right? That
yeah. I mean, think
risk
about
tolerance.
it. Yeah. Canada and Australia are in a phenomenal spot, because commodities are becoming more important, not less. The world is becoming more geopolitical risk, not less.
100%.
And if you're an investor, you're not taking that into account. I just don't understand why you would be buying something in Latin America when there's a ton of exploration. And here's the other misconception. There's a lot of unexplored property in Canada and Australia. I mean, it's, as I look at my own property, we got 30 kilometers in our package, on our James Bay package in Eclair. And we're just getting out there and doing the IP studies. And I was up in a helicopter this summer with our chief geologist. There is years of exploration potential up there. And when we sat down with these producers, they're looking at this property and like, wow, that's a lot of property. And we have 300 kilometers of property up in Nunavut. So again, and in my former days with Ivan as chairman, it's amazing to see a junior with this much potential property for exploration. The exciting thing is we are far enough along that we're starting to make our targets count. There's the north limb of Claire that we've only done all the drilling on the south limb. If we get something on the north limb, that could double the asset. We've got more to do there. Plus, we got the joint venture where it's only 50 kilometers north. It's literally, like hitting a golf ball over to Eleanor. It is right there. And when we went up in the helicopter, there's outcroppings everywhere, and they've explored some of that, but they have not done any drilling. And as they said to us, we know there's gold there. We just don't know how much. So we're really excited to get there next spring. We get zero valuation for that. No one's talked about it until I came on board. There's a lot upside. And then going up to Committee Bay, we'd like to go back next spring or next summer. And that's where the big gorillas are. We've talked about it many times, but it truly is. And again, going back to the geopolitical issues, if you're an investor in gold, why wouldn't you go up there? Agnico Eagle is 150 kilometers away from us with their massive projects, and we've got one of the best drill holes we've had in a decade up there, sitting there ready to be sort of explored more. The key point to that was we're hitting on a shear zone, which is not what we've been really looking for. It's there's 1.3 million ounces at Three Bays, which is where it's located. There's a camp there. We had our last drill hole come through, and it basically proved that it extends, all that extends lower, and these shear zones can go for miles. So it's exciting. And so we'd like to go back. We just got to make sure we're doing it in the right way financially with a good market.
Yeah.
Get credit for it.
Yeah. And that's a tough, you got to make some tough decisions there when you look at the market, right? Because I'd say 10 mil for a junior, it's a healthy treasury, right? You've got to determine when to put that cash to work in relation to when you can go back to the market for more money should you need it.
Yeah,
right?
yeah.
And
yeah.
you can put out the best news ever in a flat gold market and nobody cares, right? Which I don't necessarily hate. Like, I know that bothers you. I like the cheap share price because I can buy more. I'm patient, right?
Well, I mean, I can't sell my stocks as a CEO, and I don't want to. I'm looking to sell the company at some point. Or grow it and keep getting bigger. So I don't really care about the share price per se on a week to week basis. It's kind of irrelevant. But what you want is to be able to raise money around those discoveries and good intercepts, so that you can keep pushing in. And for us, it's not. Listen, we'd love to have more money to put another couple drills on there, but we're sitting on almost $60 million of equity right now that we could monetize at some point near term, and we don't have to come back. And that's the beauty. The goal here is it's like running your own household. You don't want to spend money you don't have. You want to be smart about what you spend it on. We all like more stuff. We'd like to have tons of things and bells and whistles, but not what we're doing here. So we've really trimmed things up. We've taken a lot of expense out of the business. Our goal is to put as much money in the ground as possible. And I'm like, look, I got family and friends and long-term relationships. I can't go look at them in the eye and say I needed to pay for a business class seat because I felt like taking business class seat. And it's marginal money, but it's about really being smart and disciplined over time. And you'll gain the trust of your investors, and when you gain the trust, it allows you to do more with what you have.
Yeah.
And when you go out and do an acquisition, you better make sure it's going to be accretive or strategically advantageous, and that's what you're getting paid for. And so that's how I look at building it.
So I like the strategic relationships. I like the confidence that gives me, and who has confidence in you, speaking about a firm like Newmont, the continued relationship. You're continuing to build that. I like the simplification of the business model, releasing home stake to Dolly Varden, but keeping that optionality so it's still in play. And then you can focus on two great jurisdictions within Canada, Nunavut and Quebec. What can we look forward to, Tim? Like, what's near-term time horizon news flow look like if investors are thinking what's next for Fury Gold?
Well, look, I think there's a lot more drill holes to come this fall. Percival is something that I'm really excited about. As I mentioned, it's 14 kilometers to the east of our core asset of Eau Claire. I think there's a potential to have some great drill results out of that. We're getting a better understanding. We're drilling into other parts of Eau Claire, but I think Percival could be a game changer for us. I'm really excited about getting on and targeting the spots we want to go up to the joint venture. And from a also relative point of view, there's a lot going on with Dolly Varden. They're having a lot of success there, and I don't need to pump up another company per se, even though we're on the board and own it. But I really like Sean Kunkun. I think he's smart. They're allocating things to build that to step out away from. They're not just going to the resource. They're stepping out. They're making that asset bigger.
Yeah.
And there's a real desire, and this is where I think there's other alignment, Jay, that people don't think about is, look, I'm not saying Hecla's going to buy it or someone else is going to buy it, but the truth is these companies need to get bigger. And if you have a great silver discovery, investors like Fidelity want them to get bigger. They want a Hecla to get bigger because they want generalists to be coming in this space. They're not thinking about investing tomorrow. They're positioning these companies for a year or two down the line where they could take big chunks of their cash and allocate it. And they need the space to get bigger. They don't think that precious metals is going away by any means. It's a very viable diversification asset for these companies. And but how do you get the liquidity to get them in there? So I think that Dolly Varden has a great pathway for success. I think investors should watch that really carefully.
Interesting.
And it's worth a lot to us. I mean, our valuation right now is really trading in line with our marketable securities and cash. We're not really getting, and that's not unusual. I think a lot of people are facing that right now. When things go right, this sector is unbelievable. It'll take off. And the problem will be for investors is they won't be fast enough to catch it.
I've seen that before, man. Yeah,
Yeah.
I agree with you. Look, Tim, this has been fun. I'm glad you made the time to come on, get in front of my audience, introduce you to my crowd, and I want to do it again soon.
Yeah, no, Jay, listen, it's been fun getting to know you better, and thrilled to be here and look forward to doing it again.
All right, thank you for watching this interview. Now, 3 things before I let you go. Number 1, I publish a weekly newsletter and I love writing it. I share my biggest takeaways and action items from the conversations that I have on this channel. In addition, my thoughts on current events, economic events, political events, and you can subscribe for free. Just hit the pinned comment right beneath this video, or just go to jmartin.club and you can subscribe on the website. I'd love to have you join the team. Number 2, ad revenue from this channel is donated to an organization that is super close to my heart called Zero Ceiling. Now, Zero Ceiling's mission is to end youth homelessness, and the way they do this is by giving at-risk urban youth the opportunity to relocate to beautiful wilderness areas and then provide them with supportive housing, career training, and just generally positive influences on their life. I love what they do. Check them out if you're interested. And number 3, if you prefer to listen to my content as opposed to watch it, you can find me wherever you listen to your podcasts. Just search for The Jay Martin Show. All right, thanks again.